Welcome to another episode of Quest for Twice. Today is February the 8th. Last week, several mega tech companies reported their earnings. So today I'm going to review the earning updates from three of them: the Meta platforms, Amazon, and Google. So I updated the revenue for each year in the last 10 years for Meta platforms, shown on the top right. Now I think it's clear that the revenue in 2020 and 2021 were affected by the pandemic. Now 2022 is having a hangover and complicated by the slowing down in the economy and the digital advertisement market. As a result, we can see that the Meta platform's stock price had a violent year starting the year around $350 and bottomed out under $100, then had a violent rebound, reaching $200 in last week. So its fourth quarter revenue was down 4% year-on-year and up 2% on constant currency basis. Management also gave a guidance of first quarter 2023 revenue would be down by 4%. Its operating margin came in around 20%. That's a big decline from 37% 1 year ago. However, Meta Platforms took a $4.2 billion restructuring charge in last quarter. That's 13% of its revenue. So if we add 13% back to 20% ops margin, we get 33%. It's not too bad a decline from 37% 1 year ago. So what drove the margin decline? It's the R&D expense up 38% year-on-year. And also operation loss increased to $4.3 billion from metaverse investment, compared to $3.7 billion in the third quarter last year. So if we strip it out, then I think the underlying business is still healthy. That's also shown in the yellow line in the top right chart. That's the gross margin. We can see that the 2022 gross margin was only slightly less than 2021, and that's also partly affected by the restructuring charge. So I would say its revenue was stagnant compared to 2021, which was boosted by the pandemic. But its profitability has been stable if we strip out the impact from restructuring and increased R&D expense. The management gave an important guidance. That's $5 billion less expense in 2023 and $4 billion less capital expenditure from prior guidance. That means $9 billion of more free cash flow in 2023 compared to prior guidance. Clearly, the investors like it and drove a huge jump in the stock price last week from a little over $150 before the guidance to touching $200 after the guidance. Let's look at the underlying business performance. Facebook daily active users increased slightly in the last quarter, same as family daily active people metric. Impressions were up 23% compared to 1 year ago, but the advertisement price was less. So putting everything together, we can see that Facebook average revenue per user in last quarter was $10.86. That's about a 6% decline from 1 year ago. But importantly, if we compare it to the fourth quarter of 2020, the revenue per user was $10.14. Then the revenue per user from last quarter was still higher by about 6-7% compared to 2 years ago. The same story applies to the revenue per user in US and Canada, Europe, and Asia Pacific. But for the rest of the world, although the revenue per user was the lowest among the regions at $3.52, but it's actually higher than 1 year ago of $3.43. It shows the endurance of the Facebook as a social network platform. Now let's look at the valuations. At $187 per share, its EV over gross income is around 5.1. So that's not a screaming buy with a valuation level at 3 at the end of last year, but still significantly cheaper compared to the years from 2012 to 2021. So we can say maybe the market was overly optimistic at the end of 2020 and 2021. The EV over gross income of 9 or 11 would be overvaluation. But at 5.1, it is still likely attractively priced. And the cash flow yield greater than 10% despite the investment in R&D and Metaverse. Meta generated a huge amount of cash flow, $58 billion and $39 billion in 2021 and 2020, and $54.6 billion in 2022, excluding the restructuring charge. It spent about $20 billion and $22 billion in 2021 and 2020 on capital investment, and bumped up to $33 billion last year. Now the new guidance is holding that flat in 2023 because the investment amount is much less than the CFFO. Meta spent $45 billion for share buybacks in 2021 and $28 billion in 2022. So that's 10% of the market cap before price jumped in 2023. So basically, the market is forecasting stagnant growth, and at current price, basically the upside is free to an investor. That includes Facebook revenue growth outside the US and Canada, WhatsApp, and Metaverse. Now a quick update on the risks. The emerging new threat is European Union may limit the use of first-party data for target ads. That's a serious threat against the fundamental business model of Metaverse. So the upside potential has to be balanced by this new threat. I don't have a clear idea on the probability of this threat. That means I'll just have to size my investment accordingly, appropriate for the level of uncertainty. Amazon reported a lackluster earning last week also. Its sales growth in last quarter was 9% year-on-year, compared to 15% in third quarter and 7% in the first half of last year. The third quarter growth was benefited from Prime Day timing, so it's a fluke. Management gave a growth outlook in first quarter this year between 4 to 8%. That's a slight deceleration from growth last year. It's a little alarming to see AWS decelerate to 20% growth compared to 27%, 33%, and 37% in previous quarters. The other segments were struggling as well, with the exception of subscription that actually ticked up in terms of growth year-on-year. That likely reflected the price increase in Amazon Prime. The number of Prime member probably is growing in the same rate as previous quarters. Its ops margin came in around 2% compared to 2.6% 1 year ago, and a 3% margin in the first half of last year. However, its charge from restructuring and impairment was amount to 1.8%. So its operation margin is actually not bad. If we look at the direct cost, the fulfillment cost as a percentage of revenue continued its downward decline. Tells me that the management is making progress in controlling its cost. The COGS rate ticked up compared to previous quarters, but that's likely affected by the impairment charges and the restructuring charges. And the operating margin was also negatively affected by the 30% increase in technology and marketing cost. But I'm not too concerned about this type of cost, because I consider them as an investment for future growth. AWS ops margin was 24%, compared to a norm about 30%. As I mentioned earlier, its growth continued to decelerate from a high about 40% year-on-year to 20% in the most recent quarter. That's a similar trend as Google Cloud, but that's a reflection of the macro economy, not an indication of market share loss. Its enterprise value over gross income is around 5 at $100 per share. So that's lowest in trailing 10 years, except 4.1 at the end of 2022. That's before the violent rebound year to date in 2023. So I believe Amazon's stock price is still attractive. Now let's look at Google or Alphabet. As shown in the top right, Google Cloud revenue has been growing with a CAGR about 38% in the last 5-6 years. The last year, the growth decelerated to 32% year-on-year, likely reflecting the general business environment. Now let's look at Google services. That's mostly revenue from advertisement. We can see the segment revenue in 2020 was below trend, and the revenue in 2021 was above. Now the revenue in 2022 was slightly below trend. So that's most likely a reflection of the distortion by the pandemic, as well as the advertisement market slowdown, as I mentioned earlier. Same case with Facebook, but less affected. We can see in the bottom right, Google service segment ops margin had a big jump in 2021 to about 39% before declined to below 35% last year, but it's still higher than 33% before the pandemic. Now let's look at the revenue and the margin by quarter. In the most recent quarter, its service revenue actually declined slightly, partly affected by the currency headwind. Investors probably alarmed by the declining ops margin for Google services on quarterly basis. In the third quarter of 2021, the ops margin peaked at 40%, then started to decline every quarter and reached about 31% in the last quarter. The management announced layoffs and consolidation of real estate. So there will be charges in first quarter of 2023 to defend the margin. So I expect if we exclude these one-time charges, then Google's ops margin will stabilize above 30% going forward. Just as a reminder, most of the operation income was generated by Google services. The other segments have been losing money. However, despite those losses, the return on invested capital for Google has been above 20% in 2022, only a slight decline from 2021, despite the big revenue bump from reopen. So there is no indication of underlying business weakness based on the capital efficiency as a metric. Now let's look at the valuation and the risks. Using enterprise value over ops income, we can see in the chart on the right, they bottomed out at the end of 2022. Despite the recent rebound in stock price, this metric has really been cheaper in the last 10 years. Of course, there are short-term headwinds, including foreign exchange rate and slowing ad market, but there is no reason to doubt Google will continue to grow once the current soft patch is passed. This concludes the latest episode of Quest for Twice. Until next time, happy investing.